Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Hey everybody, on today's episode, you're going to hear a continued conversation that I had with Blaise about some of the strategies and tips and advice for networking, for trying to break into venture, as well as kind of some examples of what a typical path in venture looks like, just because it is a little bit different from the kind of hierarchical, rigid structure of working in investment banking or private equity investing. So we spent a little bit of time talking about that, a little bit of time talking about how to differentiate yourself in these processes, because oftentimes these firms will have kind of one-off or, separate processes where they aren't, coming to campus and recruiting in the same way that a lot of the larger banks do. So I hope you enjoy the conversation. And without further ado, here it is.
Craig, I come from sociology and Spanish background. I've had internships in marketing and journalism before, but obviously the venture capital space really excites me. I'm curious if you think I am at a severe disadvantage not having studied econ or math, and if it might be better worth my time to try to get into one of these venture capital firms, like in their marketing department or in another department, and then try to make an internal transition if it continues to interest.
No, and actually, like for venture in particular, I feel like having that like deep finance background is honestly like less of a differentiator, because a lot of venture, especially early stage venture, is so much more focused on the founders, the idea, trying to triangulate around, the potential size of the market and the business opportunity, that all of the numbers that go into it in a lot of ways are kind of made up. And so all of this like heavy duty, like 3 financial statement, like DCF modeling is helpful to know. And it definitely plays a role in the venture process, but it is way de-emphasized relative to particular industry interests or like subject matter interests. So for example, like there are VCs that invest in like consumer goods, consumer products, consumer technologies. And if you want to go work for them, then the more you know about consumer products, like that just matters so much more. And like a love and a passion for a particular space in a particular area matters so much more than like being a heavy duty financial modeler. Which is also to say, like, if you were trying to think about like 20 years from now, what is your dream job? And if you say your dream job is you want to like run your own venture fund, or like you want to be a partner at like a big venture capital fund, then that path has a lot more of like a winding road and a lot more opportunities than investment banking or private equity. And what I mean by that is that in a lot of ways, the job of like venture changes a lot from being an analyst or an associate to being a partner. When you're an analyst, a lot of what you're doing is sourcing. So if you're working in venture, a lot of what you're doing is sending cold emails or like cold, outreach to founders to try to learn about their business. And you're basically trying to like extract information from them about, their product, their company, their vision, their pricing, how much traction they have. And you're trying to basically do a combination of like get intel from founders as well as build relationships with those founders. Like in a perfect world, you learn a lot about what they're doing and you're genuinely interested in it, and you like build a relationship where maybe like you can connect them to somebody or like do something that's helpful to them. You learn a little bit about the space. And then as you have enough of those conversations, you basically as a venture investor are coming up with theses about a particular trend or a particular niche or a particular like area where you want to invest. Then you do as much as you can to learn about all of the companies that are building something in that area. So one example is, if you're interested in journalism, or you're interested in kind of like the creator economy, then the first thing you would do is you try to be like, okay, like first, can I validate a thesis around this, right? Because like journalism, traditional journalism has been structurally declining. So you would need some thesis of growth. And that could be in the creator economy. It could be in podcasting, or it could be in advertising revenue that is adjacent to this creator economy. And basically what you would do is you'd read a bunch of industry reports, you'd try to talk to as many people as you can, and then you'd first try to validate, is this an interesting space? And then you'd go, depending on the stage of your venture fund, like different venture funds try to invest in like super early companies, or kind of like still startups, but they're growing and, or later stage. And you try to find a company that is secularly growing within the thesis that you created at a stage that is investable for you. And it's not like startups are just perpetually like trying to raise money. And so there's a little bit of a timing element too, where you might build a relationship with them now, so that when they raise or launch a round in 6 months, you've already met them, you already have gotten to know them, and you're kind of top of mind for them when they're thinking about, building out who's going to invest.
And do most venture firms, I'm sure it depends on size, but do most of them focus on one industry or kind of a host of a few industries, or does it really just depend on the size?
Even the generalist funds are thesis driven. I think pretty much all good venture investors try to be thesis driven, where at any given quarter, year, month, there is a set of anywhere from 3 to 30 themes that they've validated or that they're working on validating. And they're trying to find an investment that fits those themes. And I think that, by the way, is one of the things that differentiates a really good investor from an ADD investor, is sort of like, if you came into 2023 with a set of theses around, whatever industry topics, and then all of a sudden OpenAI like catches everybody's attention, and now you're pivoting like all of your focus to investing in generative AI, when you as an investor are not an expert in that space. You haven't spent years following companies, building relationships with those types of businesses. You likely will only get access to companies that are not the top companies, because the top companies basically want the top, like, smartest investors who've been like thinking about their space and can add value to them, where they already have relationships. And it's just very unlikely that you could pivot on a dime like that and not suffer from an adverse selection problem, where the company and founder that takes your money is not, the company or founder that you want to be investing in.
Got it. And so last question, in terms of like applying to venture firms and whatnot, what would you say are like the most important skills to have, right? You mentioned the interview process might lean a little less heavily on like understanding DCF modeling and all the numbers. What are some things that can really make you kind of stand out in the application process?
The fascinating thing about venture, first, in a lot of ways, it's still kind of a cottage industry, by which I mean, there aren't these behemoth venture firms with thousands of employees that have regimented analyst hiring processes. A lot of it is kind of one-off, and a lot of it is you kind of creating your own job opportunity. So it's a lot of leveraging either your existing network or cold outreach, or like finding alums from your school that work in venture, and doing your best to try to build connectivity with them and see if you can create a job for yourself. That's kind of the biggest thing I would say. And the number one skill that VCs value in a straight out of undergrad or like, recent undergrad analyst is basically how, what is your work ethic and what is your ability to represent their fund well, which is basically to say you'll be doing a lot of sourcing deals, which is a lot of cold outreach. And it's like a lot of, not the most fun work to be doing, unless you're really passionate about the types of businesses that VC invests in, And if you can show that you really care about the particular industry and it's just really exciting to you, then they will think, well, hey, like, everybody's going to like work hard, but like you actually love it. And if you love it, then one, you're going to represent the venture firm well, because your email will have like, at, that venture fund's name.com. And so you are kind of a brand ambassador for the fund. And so if you kind of seem dispassionate or like annoying or like aren't representing the brand well, then you're, negative help to them. But as long as it's an industry that you're passionate about and you want to learn about the space, I think that enthusiasm, as much as you can communicate that, is the way to do it. And I think, by the way, if you're like in an interview process and you're trying to differentiate yourself, or if you're doing cold email outreach and you're trying to differentiate yourself, the number one kind of prep work that you can try for venture interviews is trying to do your own thesis development. And what I mean by that is, if you go into an interview and you're like, hey, like, I'm smart, I'll work hard, hire me, and I'm super enthusiastic about what you do. That conversation is very different from a conversation where you go into a venture interview and you have a pitch for them, where you can say, hey, like, I think you should, and just, Blaise, we were talking about this company earlier, and I know they've already been acquired, but I know you're interested in kind of journalism and podcasting. And so one thing you could say is like, hey, I'd pitch an investment in Anchor. It's a very value add tool for independent podcasters. In your pitch, you would talk about the market in which Anchor operates, and you try to do some math around like, what is the revenue potential of Anchor's business? Like, how many potential users do they have out there? And what is the per year willingness to pay of those users for a service like what they're building? And what you really want to get to is you want to get to an addressable market, which is basically to say, if they get 100% market share and every possible user who's like out there is using them and paying a reasonable dollar amount that you feel like you can justify, if that is more than $1 billion a year of potential, you've picked a company that operates in a large enough market. And so ideally you want 10 billion plus, but really 1 billion is kind of like the minimum. And if it's less than that, don't pitch it. And so in your kind of pitch, you want to focus on a large addressable market that is secularly growing or that you're excited about, which is basically like you care about the industry. And then you want to do some research on what companies and what competitors are out there that are trying to do a similar thing. And so actually in Anchor's case, I think, so they got acquired by Spotify. I think it was for something order of magnitude like $200 million. And that, by the way, is like an okay venture outcome, but it's not a great venture outcome. Venture investors want, billion-dollar, multi-billion-dollar outcomes.
No, it's so interesting. So you mentioned something that could separate you in the interview process is coming at them with a pitch. Do you think that hiring managers and interviewers give you the space to pitch to them?
Yeah, because a lot of times you're creating your own job. Like, a lot of this isn't just like you apply to a generic application and there's an interview process where there are like 20 candidates. A lot of this is like, you might cold outreach someone like, hey, like, I'm a senior at Middlebury College, like sociology major, but I've spent all of my my summers interning in, journalism or marketing or kind of like whatever space you've been working in, or, you're a Spanish minor, you're multilingual, and you have these series of interests. And you could say something to the effect of, I saw that you invested in company X. That's interesting. So you find, a venture investor that invested in like Duolingo or, whichever company. And by the way, like, venture funds part of being a cottage industry and like part of these funds being smaller is you might have heard of 0 VCs or like 5. There are very, 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 very few undergrads that could name 10 venture capital funds. And so the way I would recommend going about finding funds that you think are interesting are to find companies that you think are interesting and Google like company name fundraise. And there are websites like PitchBook is a really great resource where you can look up a company and see, who invested in them at which stage. A lot of schools will have student PitchBook accounts that you can, like, if you're an active student, you can usually find a way to get it for free. If not, it's like super expensive and like not worth getting for you on your own. So then you're stuck like Googling company name fundraise and trying to find a TechCrunch article where they talk about it. But that is literally how I would go about it. That is literally how I would go about it, which is to say, like, find the companies you're excited about, then see who invested in those companies, then look up those funds and see if they invested in only that company and then a bunch of other random stuff that you don't care about, or like if they are regularly investing in companies that you're excited about.
So you got to kind of be scrappy throughout this whole process.
Absolutely. And scrappiness, like nothing is more valuable than scrappiness in the venture world. And that leads to another kind of interesting observation about the venture industry, which is that in hedge funds and investment banking and private equity, the way to be a partner at these funds is to work your way up the ladder. You basically can't be a VP at an investment bank if you weren't an associate at an investment bank. You can't be a managing director at an investment bank if you weren't a VP at an investment bank. It's very structurally hierarchical. By contrast, in the venture world, it is pretty difficult to get promoted from, principal or associate at a venture fund to partner. And a ton of partners at venture funds were entrepreneurs as their most recent thing. Like they started a company, they grew the company, they sold the company to partner at a venture fund. And it's a lot harder to work your way up because the job actually changes a lot. And so that's kind of the other interesting thing is if you want to learn about venture, if you can get an analyst job straight out of school, like that's great. Like be an analyst, then be an associate. But in your head, as you're trying to think about your career, one path that you could take is spend a few years learning about how venture investors think and build relationships in the venture community. And then at some point, you'll build a thesis around a particular sector that your firm has validated, like the partners at your firm are signed off, like they think it's a good idea. And you just won't find a company that's building something in that area. And then you'll quit and you'll start that company. That's like the way you'll do it. And the way you'll move up in the venture industry from kind of mid-level to the partner level is by investing in yourself and taking a risk. And so that is also to say that if you're really ambitious and you really want to work in venture and you don't get that analyst job in venture, it is not even close to too late for you. Like you have 15 years to like go find an interesting company to work for, go find a startup to work for, observe operationally how that startup works, how they build, how they grow. And then maybe if you like stay with one company that's been really successful and then you quit, you might go to a different, even earlier stage company where now you have a little bit more of a senior role. See how that company grows or doesn't, inevitably like one or both of these like won't pan out. And you'll have exposure, like an operational experience, growing a business, seeing how business has grown, and then you'll start your own company. But that is what I like to say to people is if your only goal in life is to be a partner at a venture fund, you are more likely to achieve that outcome by starting your own company than you are by finding an analyst job at a VC and planning to only work at that VC forever.
It just seems so much less structured than investment banking and whatnot, as you've
It
mentioned.
is. It is. The amount of capital that venture firms control is much smaller than private equity. It's much smaller than hedge funds. These firms are much smaller, generally than a lot of these other firms. Like the big VCs like Sequoia, Andreessen Horowitz, Foundation, like some others. These are bigger firms that have much more regimented processes. But one of like the best VCs around is a VC called First Round, and I'm biased because their like dorm room fund was like the first investor in my last startup and Profit, so I'm very biased towards them. But they were started in 2005, and it's a small team, and a lot of the great venture investors become great venture investors because they found 3 companies at the earliest stage that happened to make it big. Like they were, the early investors in Facebook and Airbnb and Uber, et cetera. And then that kind of like builds their brand. And so like Sequoia is the one example of like, they've been around forever. There's this huge list of greatest hits. They're like the Rihanna of like venture investors, where they have all these like top 10s and number ones. But I would be willing to bet that there will be at least one of like the top 5 venture investors in 25 years will be a venture firm that today nobody's really heard of.
Mm. It's fascinating. Yeah, it just seems like in consulting, they're like what the big 4, and everyone knows the big investment banks and whatnot. But it seems like the venture space is unique.
Yep. And private equity is a little bit similar. Like in the investor space, it's all about what have you done for me lately? What are your returns? And who are the people still at the firm that have these legendary investor reputations? And venture is particularly interesting because a common strategy in venture is you might try to design a portfolio of 30 to 50 companies in every fund. And right after this, I want to talk a little bit about fund structure, just so we can talk about that. But the idea is basically we have 30 to 50 at-bats where we'll invest in 30 to 50 different companies. And their goal is often like they expect and don't mind and are perfectly content with 80% of those companies utterly failing, shuttering their doors, returning $0 on the investment. And their whole goal is they want some small number of companies that like do reasonably well and do okay. They want 2 companies that return the whole fund, which is basically to say if they have like a $500 million fund, they want to make $500 million off of one company. And then maybe, $500 million off of a second company. And then there might be 8 others out of the 50 that generate, 2, 3, 5, 10, $40 million. And that math adds up to that fund returning something like 2.5 to 3 times the dollars that it started with. Venture funds vary tremendously in size. I think like at the very, very large end, there are like $2 to $4 billion funds. But most venture funds that you'll find might have something like $100 to $200 million funds. And so if you're trying to do math about like what stage and like what, size of company they're investing in, if it's a $100 million fund and they're trying to invest in 30 companies, that's like $3 million of like average check per company. And usually investors like to double down on their wins. So if you're a very early stage investor, you might like put in, $500,000 as like what you just invest when they're at the earliest stage. And if they're doing really well and 2 years later, they want to raise more money and you've seen how they've grown and you're really excited about the company, then you follow on with another 2.5 million or like another 5 million. And so you're trying to like double down on the winners. And then the losers, a lot of them like might not get to raise another round, or they might raise one more, but nothing after that. And so that is kind of like the ethos and style of venture investing. And you can imagine this is where like DCF analyses, like a lot of these valuation analyses are helpful mental models, but you're never going to build a DCF. And a version of like why it's helpful to have in the back of your head is like you pick a valuation and you pick a price with all these companies. And so if you are the earliest investor in Airbnb, you know, if you were the first investor, no matter what, you're making a lot of money. But depending on whether you picked a $5 million valuation or a $10 million valuation or a $20 million valuation for that, grand slam of an investment, whether you came in at like a 5 or a $20 million valuation can determine whether you made 50 times your money or 200 times your money on that deal. And a lot of the way that venture investors like to think about this stuff is they like to think, okay, like for public companies that look like this company, what are they worth and how are they valued? And they try to work backwards to like, let's say this company becomes a public company, the same size as this other, so like in consumer, Kava is now, I don't know if you've ever eaten a Kava, it's now a public company as of last week. And if you were going to be one of the early investors in Kava as kind of like a fast food, like Mediterranean theme, where like the serving style feels similar to Chipotle, as an early stage investor, like one thing you might do is say like, how's Chipotle valued? Like they might be valued at a price to earnings ratio where their like price per share is, 35 times what their earnings was last year. That's a little bit not helpful to you as a venture investor because you're investing in these unprofitable companies that have negative earnings, but you might look at like their price relative to their revenue or their price relative to their revenue and growth. And then you might say, okay, like I think that Kava will grow at a similar rate as Chipotle, but it might be smaller. Like maybe just like the market for people who like Mediterranean food is like structurally smaller than for people who like Mexican food. And so that's kind of like the mental models that you're building. And then saying like, if this is Chipotle, but a tenth of the size in 8 years, then in 8 years, it would be worth a tenth of what Chipotle is valued at. And so now I want to work backwards and basically say like, what price do I have to invest today to make this a 20 times return for me, or a 50 times return or whatever you want to underwrite to.
It just seems pretty like abstract and almost subjective.
It's totally abstract and subjective. And there are also all of these funny things like in growth stage venture, like, which is to say like growth stage refers to later stage. So these are companies that have been around for a few years. They have hundreds, if not maybe 1,000 employees. Like these are starting to be really big, like household names. Like in today's terms, I would consider like Airtable, which is a company that, basically makes kind of like an Excel on steroids in the cloud type of like spreadsheet. They are still a private company. So when they take investment, it's from later stage venture capital investors. And at that level, they're like one round away from an IPO and being a public company. So the mental model is like, if they went public in a year, what would they be worth? And I'm going to pick a price today that allows me to generate, like what I expect would be a 25% return per year, or a 35% return per year. And I'll work backwards. And as a venture investor, you want to invest at the lowest valuation possible. Like you want to invest the most money at the lowest valuation. But then, this company will go out to multiple venture investors and there'll be a bidding war and they'll like try to, get you to the highest valuation. And as you get earlier and earlier stage, it's a lot of working backwards from increasingly uncertain and abstract levels. And at the very earliest stage, that's where it starts to be about like, let's pretend this works. What could this be? And if it can't be a big thing, then all of the uncertainty makes it hard to invest in it. One heuristic that I've heard, this was a Wharton professor I had named Carl Ulrich, who's like a famous academic in kind of like the venture space. And his kind of like mental model for like the earliest stage of venture investing is rank the founder or like the founding team on a scale of 1 to 10, rank the idea and like the market potential for the idea on a scale of 1 to 10, and then open up a random number generator in your browser and have it pick a number between 1 and 10 and multiply them all. And you'll end up with a number between 1 and 1,000, which is to say, like, you want a 10 founder pursuing a 10 idea, like in a 10 market. And then who the heck knows? Like, there's a luck factor. And so eventually, like on the luck side, you'll roll a 10 and you might find 1,000. But if you're only investing in founders and ideas that are like 3s, 4s, 5s, when you get lucky, you're not capitalizing on the opportunity, is kind of the theory. And the best example of that is there's like endless case studies of things that became successful by virtue of luck and things that failed that were otherwise great ideas that failed by virtue of luck. And I think COVID and like the shock of that is the perfect example, right? Like Zoom would not have been Zoom without the pandemic. Likewise, by the way, like there were all of these great like retail ideas that just died because nobody was going out. If you were in the, medical face mask, like the N95 face mask production business, you never in a million years in 2018 could have expected what was going to happen.
Or like hand sanitizer, all that.
Exactly. Yeah. And so that's just like luck happens, things happen. There's stroke of the 10 risk with governments where this was one thing that happened in venture a few years ago where the US military basically only bought from very large established old companies. And then all of a sudden there was a legislative change that allowed them to start using startups as vendors. And there were startups that existed that were making, military grade stuff. And then all of a sudden that like stroke of the pen changed, just like overnight changed, their trajectory and their potential.
Wow. Yeah. It seems like you got to just have an eye for it too. It's almost like an innate thing at a certain point, or I'm sure you kind of develop the eye as
I'm a skeptic there where it's just like, there's just a lot of luck and it truly is luck. There are some companies that if you hear interviews with some venture investors where it was just obvious that that company was always going to be a winner. There are very few of those. And, then it's just a matter of like, can you get an allocation? Like everybody wants to invest in them. Like, can you just become get a slice of the pie? But for the most part, it's luck. And you just have to make sure that over the course of your, life as a venture partner leading deals, like you might lead 20 deals, 25 deals. You need one to hit big. And invariably, you will get lucky with 2 or 3. And you just need to make sure that you invested behind a big enough idea, a strong enough team with large enough potential that you're capitalizing on the luck when it comes.
Right. And Craig, one other thing I wanted to ask you about is it seems like based on how you've kind of described this space, that building relationships is like super important as a skill.
Relationships are everything because the math in a lot of ways is heavily deprioritized. And so as a result, building like and trust is important everywhere, but it's particularly critical in this space. And that's why, by the way, venture funds love hiring former founders as partners, because not only do they know their space really well, having lived it and having been the CEO in this space for a number of years, but their competitors or their former competitors or their former collaborators are friends and colleagues. It's not this like decades of like adversarial relationship where it's like an investor and companies and like maybe they trust you, maybe they don't. This is like you built a company, you sold it, you made it big, and now you have a chance to invest in your friends, and they will all come to you and want you to invest in them. One, because they like you, and two, because you can actually provide valuable advice, having been an operator and an entrepreneur in this space. And that's why just like the role is so different. Like as an analyst, as an associate, as kind of a junior mid-level person in venture, you're just trying to volume source opportunities. And your ability to like cold outreach and source those opportunities is not what is going to have people approach you as someone who they want investing in them. So that's where like the venture path is a lot less continuous than the private equity path or the investment banking path.
Right. So you got to be scrappy. You got to be good at building relationships. Bonus if you started your own company and you understand a specific, industry really, really well. And yeah, those are the ingredients.
And so that's if you're an undergrad and you think venture is super exciting, the two things I would do in parallel are, one, find companies that you're really interested in and excited about. Then Google like company name. If you have PitchBook, then go on PitchBook, look up the company and look at everybody who invested in them. If you don't have access to that, then Google company name, fundraise, look at the names of the investors and the investment firms that invested in that company. Go to the investors' website and go to each of them. Look at all the companies that they've invested in recently. If you've heard of them, great. If you haven't, like go to their website, like see if it looks cool. And then I would do two things. One, see if you can cold email or like find a way to get connected to one of the investors that works at that venture fund. And ideally, before you actually cold email them, try to do some exercise of like having a pitch, which, just to recap, having a pitch means looking at a particular subsector that you think is an exciting subsector. So an example of that might be creator economy journalism, or it could be smart home applications. So like one example of this is a thesis that isn't mine, but I heard recently, is that the growth and proliferation of electric vehicles is causing elevated and increasing installations of batteries in people's homes and garages. Monitoring that battery capacity introduces people to downloading on their smartphone an application that tracks electricity usage in their home. And that could be a catalyst for unlocking smart home applications and getting people really excited about using smart light bulbs, smart refrigerators, smart washer dryers, because consumers can observe the energy savings of utilizing those smart appliances versus legacy appliances. And so that could be an example of a thesis you might develop. And then what you would do is you would say, okay, what are some startups that are approximately in the stage where you think this venture firm would invest that makes a product that fits the thesis? So you might look at branded lighting manufacturers. You might look at, smart refrigerator manufacturers, smart windows and shades. Like if I don't know if this company exists, but if there are windows that like, are basically like transition sunglasses that have a brand, like if you can find a company like that or some set of companies that fit within this thesis that you've developed, and then you can say, I found this startup that makes, transition lenses for Windows. And when I think about the market for this potential company, I would say, one, like, who do they sell to? And if they primarily sell to like homes and residences, I might say like there are X $100 million homes in the US. The average price point of their windows is $30 a panel. On average, there are 15 panels per home. And so I'll say $30 per panel times 15 panels per home is $450 a home. And if there are $100 million homes in the US, I'm making all these numbers up. That's, call it like a $45 billion addressable market. And that's your pitch, is basically like, here's this thesis I've identified that's interesting. I found this particular company that is doing something cool in this area where there is no like big established competitor. They have this cool brand, they have this cool website. They look like they have some early traction. If they're really successful, this could be a $45 billion, revenue a year company. And by the way, if you hear people say TAM, that is a venture vocab term, which stands for total addressable market, which is exactly the math we did, is like, what is the per year revenue potential of this company if they capture 100% market share in whatever they're doing.
Cool. And we've went through kind of the different aspects of this pitch. Could you throw this all in like the first cold email you send to someone at a
Yeah,
VC?
why not? Yeah. If you are particularly enterprising, and this is a lot of work, but you could put all of this in a PowerPoint presentation that you make look very pretty and formatted. You could PDF it, and then you could send this PDF of a sample pitch and sample thesis of an example of some work that you could do and would do for that fund. And then you attach that PDF to every cold email that you send. And it could be the same one. Like, it'll be like if you're sending a consumer pitch to a VC that only invests in generative AI ideas, they'll say, you clearly didn't look at our website. You don't know what we do. But also, if you are picking a thesis and a pitch that you are particularly interested in, like if you want to build a thesis around like sports medicine and rehab, or around like esports and gaming, or kind of like whatever the topic of thing that you're interested in, you probably have heard of some companies that do something related to that space. And I bet by looking at the investors that back that company, you can find relevant investors. And I bet you can find at least 10 that would be open and wouldn't just be like, this isn't what we do, to the thesis that you develop.
Right. No, thank you, Craig. This helps so much thinking through. Again, I have one semester left of college. I'm beginning to think about job applications and how to approach those. So to kind of hear the different steps that might be advantageous to me is super helpful. So
yeah. And the thesis is great for VCs. The other thing you can do is just reach out to those companies. Like, if you find exciting companies, go work for them. And in a lot of times, I think you might find that outreach is like more cold. Like, it's harder to like find someone in your network maybe that like works at one of those companies. They might not be hiring. They might not be hiring for recent undergrads. They might be in a weird location that you don't particularly want to move to. But if you can find those companies and you can cold outreach to those companies, that is another great way to get into this space. Because, by the way, if you work for that company, you will learn more about that industry than you ever would as an analyst to that investment fund. Go work for that company, go help them grow, go see what a growing company feels like and looks like. And then after 2 years, then go try to be, an associate at a venture fund, or work there for 3 years and go to business school and get an MBA. And then coming out of your MBA, you'll have relevant sector experience and operating experience. You'll have the graduate degree, and then you can go into venture. There is never such a thing as too late in venture in a way that is less true in private equity and investment banking. That does it for today's episode. Thank you so much for listening. And remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.